It's great to have you all on board. Really appreciate your time. Drew, quickly kind of set the scene for us, and how surprised are you by the spike in rates?
Oh, well, this spike in rates is surprising, and it's actually one of the reasons for additional concern. You know, when people are moving towards a recession forecast and they're pricing in more Fed easing, rates should be going down, and instead they're going up, which suggests that something else is going on, whether it's people raising cash to meet margins or whether it's foreign investors shedding treasuries to get into other securities. That's kind of the open question right now, and that's the question everyone's trying to figure out.
Yeah, let me bring in also Peter Boockvar, who's standing by, kind of watching these results. Peter, thinking things through today, and I think you guys might have a nice kind of discussion here. I mean, you think the U.S. is really starting to look more like a third world country, which is not comforting at all, or the direction we thought that we were going. So just what jumps out to you? What's significant about the activity of the past 24 hours?
Well, I was specifically referencing when you see a rise in interest rates and you see a weaker currency. Historically speaking, that's what you usually see in a third world country. Now, maybe this is just a one-off day, but I don't necessarily think that's the case. I do think there's another factor here, which I'm beginning to hear some rumblings, particularly in the municipal bond market, where people are selling ahead of tax day on April 15th. You know, when the market is somewhat normal, the bid-offer spreads are pretty tight. But now we're at a point where we're 6 days away from making tax payments. People have no choice to sell. Bid-offer spreads gapping out at the same time, and people take whatever price they can get on the bid side when they sell. So I think that's also exaggerating things here too.
We can show maybe the MUB, one of those kind of muni ETFs, perhaps any kind of composite we have. We've seen the prices selling off, and we all remember COVID when the Fed had to launch that muni bond buying facility. The point here being, Drew, that it's not about whether there's problems, quote unquote, in the muni bond market. It's the broader point that Peter's making about liquidity. And when market participants are just stepping back and you start to see yields rise, then even like a state and local who's rolling over paper or something like that is potentially going to see an impact.
Well, absolutely. And Peter makes a great point, which is, you know, when things like this are happening and there's so much noise and there's so many different markets moving in so many different directions and sometimes not the way they're supposed to be moving when they're synced together properly, people forget about some of the things that matter. And one of the things is tax days coming up, which means a big liquidity drain from the market as people sell securities or just basically move cash and send it to the U.S. Treasury that then deposits it at the Federal Reserve where it leaves the banking system. And so this will be happening over the next week or two, and really not a lot of people are paying attention to it. And it's at this point, given everything else going on in the market, it actually takes on outsized importance not to drop the ball on watching the little things.
No, I completely agree. We also have Jim Bianco on standby. Let's layer you in here, Jim. You're saying, and I thought you kind of really nicely summed up what might be going on in the bond market overnight, where you say something broke. By the way, I'm not going to front run Rick here, but my guess is the 10-year auction went okay because the Dow's up 500 points and the 10-year's down about 5 basis points right now. So as things stand at 1 p.m. Eastern, how would you describe now kind of the functioning of the bond markets? I'm amazed we're still near 450 on the 10-year.
Yeah, the auction went extremely well. There was a lot of buying that came in on the auction. And that's part of the nature of a broken market is, you know, things don't behave like you would think. The backdrop for the auction would have been considered to be one of the worst that we've had in several years to actually have a 10-year note auction, and it went very, very well right now, which is why you're seeing such a big reaction in the markets. But I think really what's happened is the reason that the market sold off is that as the Dow was going down, as all the calls of recession came in, if you looked over, you saw that the market was never, ever expecting the Fed to step in. That is still less than a 50% probability that the Fed is even going to cut rates in 4 weeks. In normal period, what we saw in the last week or so, we would have been expecting the Fed to cut rates today. And I think the reason that this has changed is we're worried about inflation, tariff-driven inflation. I think that is pretty much taken the Fed completely out of the picture. No matter how bad the economy gets, Jay Powell said on Friday, we're going to have to worry about inflation more. And the market came to the realization there isn't going to be any quantitative easing or massive cutting of rates. And that started this big unwind that we've seen in the bond market.